All right, everyone. Welcome to another episode of Minority Chasers. Today we have a special guest, our econ professor from Towson University, Professor Leppo.
How are you?
Good. How are you?
Doing well.
So we're just going to get into it. We can start off by your general thoughts on the economy, the market exuberance, just anything you've noticed, anything out of the blue, any like red flags.
Yeah. There's a couple of different things that I've kind of noticed where there's potential for some problems going forward. One, and I think we're going to talk about this more in a few minutes, is the housing market. The housing market is very heated right now because of the low interest rates and the ease potentially of getting money. So I was talking with a friend of mine who's been in the real estate industry for years the other week, and he was saying that he is listing a house on a Thursday, and by Saturday, he's having multiple offers above the asking price. So I don't know if you remember, we talked about this some in class when you guys were there, that when you have something like that, that is usually a key indication without ever digging in to the actual numbers even. That's usually an indication that something's not right. Something's kind of out of balance. Mm-hmm. It's not sustainable. So that's a potential fear. The other, which we've been talking about for a very long time, is the debt, and government debt it's been a problem for a while. And then with the pandemic hitting and the need for the government to spend additional money, payments out to individuals, to business firms, at some point that's going to have to stop. I don't know when that will be with the pandemic still going on. But at some point, the money, you're going to get inflation. History has told us that anytime you have that amount of money that goes into the system, and it's just kind of flowing in as easy as it is, there's never been a time historically where we haven't seen really high inflation or hyperinflation that's come about because of that. So those are two areas that I think are the housing bubble and the amount of money potentially leading to high inflation. Those are two of the areas where I think you have a real potential for problems.
So do you see the market slowly heating up, or is it going to be very fast? Because like we just had job numbers come out today, and they added over 900,000 jobs where only 600 were expected. So it feels like we're recovering a lot faster.
Yeah, I think because of the vaccine being out and we're seeing more and more states opening up, I think you're going to see a rapid increase in job growth right now. The problem, I think, is potentially a couple of months from now, when you have the job growth and you have all this money that's been put in. If it all starts to circulate through, that's when you have the potential for this inflation. And the fear, I think, is if you have one bubble pop, like let's again say housing, where we're seeing the stock market's kind of shaky right now. If you have any one of these that really does fall, I'm afraid it's going to be this domino effect where then it's going to just kind of cascade through. Hopefully not. But my fear is with the risk of inflation or a housing bubble, my fear is that you have the potential to have another recession hit.
So what can the government do in that scenario? I feel like they've thrown everything at this pandemic, other than like maybe buying up equities, which I don't know if they even can do. But I know in Japan, I think they're buying equities. So is that something they could do here in the United States?
Yeah, they could do that. I think the bigger issue, the bigger area where you can have some benefit, which we're kind of maxed out on, is when you're talking about the Federal Reserve, the central bank. But with interest rates close to zero, and you're looking at the money that they've put in, even if you're talking like the government itself buying equities, the big fear, I think, right now is that there's going to be too much money going into the system at some point. If production is meeting and consumption, if those pieces are kind of meeting up, but my fear is that all of this intervention is going to kind of throw things out of balance. And if one of those pieces, if your production and consumption and money input if they're not matching up, that's when you have this potential for this imbalance in the system. And that's when you have kind of bad things that will happen eventually.
Yeah, so something I was noticing is with the yield curve, the 10-year, which has been in the news a lot, the two factors that influence the 10-year or the longer end of the yield curve is either inflation expectation or growth expectation, if that's correct. So I'm not sure of what the market is pricing, at least for the 10-year yield, but it seems like based on like all the moves in Bitcoin and all these inflation, I guess, hedges, seems like markets are expecting a lot more inflation rather than growth.
And if you remember, the problem when you get inflation is your central bank has to take action to get that out of the system.
Yeah.
So what's going to happen is if you have this inflation ratchet up, the very first thing they're going to do is they're going to start to jack up interest rates. So when your interest rates start to go up again, that's your contractionary monetary policy, right? I mean, it's designed to contract the economy. So when the economy is not on strong footing because of the pandemic that we've just gone through, and then you're having to contract, that's where you have this potential for some really negative economic impacts. But at the same time, you can't really leave inflation in the system because of the damage that inflation creates long term. I mean, even short term, but so their action is, even if the economy is not on strong footing, once you start to see real legitimate inflationary pressure, I think the Fed is going to pretty quickly take action to raise interest rates and start pulling money out of the system.
Yeah, I noticed the commodities have been going crazy too as well. So do you think it's smart for the Fed to start increasing rates sooner rather than later? Or because they don't expect to increase rates until like 2022, late 2022 or early 2023, which seems like a long time.
Yeah, I saw that where they're estimating, again, like you said, about a year out. They're not expecting any type of interest increases soon. And in theory, that's great until they start to see prices elevate across the board and you start to see legitimate pressure. I know the producer price index is showing signs where, in terms of those input costs for producers, they're seeing an increase. Right. So again, what's going to happen is, and you're probably already seeing some of that in real world terms. If you've been out to the store, you've ordered any things, you're seeing prices, base items that are typically not volatile in terms of pricing, that you're seeing kind of an increase in. So when we talk about that, we're excluding food, we're excluding fuel. You're talking those items being excluded, more stable areas. And I know that you're seeing things like lumber, the price of lumber and hardware started to go up. A lot of those items. So when you start to see those items increase, they tend to filter into other items. So once you start to see this across the board price increase, where it's great that the Fed's saying we're not anticipating raising the interest rates. And I think from a psychological standpoint, that's the right thing for them to say. But I think realistically, if 6 months, 8 months from now, that they're seeing that inflationary pressure, I don't think they're going to hesitate to raise the rates just because of the damage that an inflation can cause in the system.
Mm-hmm. So there has been a lot of government intervention. What are your thoughts on UBI and its sustainability and these politicians going for it?
There have been some trials with your universal basic incomes, and studies that I've read multiple studies on them, some that have been more positive, some that have not been. It's kind of a balancing act. If one of the things that I've seen is, if you're going to start adding UBIs in, are they in addition to other social safety nets, or are they to replace them to allow individuals who are receiving those incomes to make choices based on what they want to use the money to spend it on? So it's not restricted on food or certain items. So I think we almost have to define clearly, is it going to be in addition to your other social safety nets, or is it going to replace them? If it's going to be in addition to them, then I think you have to be careful, because you want to help improve standards of living for individuals, but you don't want to discourage the need for someone to go out and work, because that not only is providing income for those individuals when you're going out to work, but the other thing it's doing is, from a psychological standpoint, there's been studies that have shown when someone is out and they're working, it has a positive psychological impact on them. From a self-worth standpoint, individuals tend to feel better. So it's one of those things where you have to really be careful, where you want to do things that are going to help individuals, but you don't want to do something that's going to discourage them from going out and trying to find a job and participate in economic activity.
With the social impact of that. So recently there's been a lot of talk about raising the minimum wage. And in fact, I think New Zealand raised their minimum wage to $20 either today or yesterday. And they're taxing the rich too. So for this country, why is this such a hard thing to do? And what are like the side effects economically looking at that?
There's multiple pieces that go on when you raise minimum wage. One of the things I like to discuss in class is minimum wage is somewhat of an arbitrary number, right? Oftentimes it's not associated with a living wage, those type of things. It's almost politically, they kind of try to find numbers that play well. So one of the things I've said is I'm a proponent, if you're going to have a minimum wage, it should very much be based on regions. So to give you some insight, even if you look at Maryland, which geographically is one of the smaller states in the US, you can be in different locations within the state of Maryland and dramatically different cost of living. So if you're living in Montgomery County, the cost of living is very high. If you're living in Allegheny County, which is 2 hours away, the cost of living is much lower than it is in Montgomery County. So if you were to have a wage increase in Montgomery County, let's say you raise the minimum wage in Montgomery County, it's not going to have as much of an impact in terms of, let's say, discouraging businesses from hiring individuals as it would in Allegheny County. So because in Allegheny, the cost of living is so much less and prices tend to be lower. If the business firms in, let's say, Allegheny have to pay higher rates for labor, it's going to have a much more negative impact on them and discourage hiring. Whereas in Montgomery County, it wouldn't. So one of the things that I think from a minimum wage standpoint that we really should be doing is, instead of having it kind of universally across the board for such a large geographic location, is we should say, okay, if we're going to have a minimum wage policy, it very much should be localized. It's kind of tough when you get smaller than a county area, when you get different regions within a county. But even if you look within different counties, if you go from one end of a certain county to another in the state of Maryland, you can, even within that county, see very different standards of living. Baltimore County, for example, you can be in different regions of Baltimore County and the cost of living is dramatically different. So one of my suggestions, if you're going to be talking minimum wage, is really it should be much more on a county basis within states themselves. So with that, go ahead.
That makes sense. So with that being said, would federal capital expenditure help to close that disparity a little bit?
In theory, yes. And the reason I say in theory is if it is used for what it is intended to be used for, then I would say it would absolutely improve. So if you're talking capital expenditures, I guess you're talking like infrastructural improvements, those type of things.
Mm.
Okay. So if the money is really spent for those items and there are policies put in place to ensure that the job is going to be done and done efficiently, then that would help. The problem is, and I hate to use such a broad brush to paint this, but in the US, we have for decades a very bad history of infrastructure projects that either the funding doesn't go where it is supposed to go ultimately, or it goes to where it's supposed to go, but it is very inefficiently used in the process. I tell the story that when I go to Ravens games, there's a person who sits near me. And he has a construction company and he works on roads and bridges. So he's kind of infrastructure. He and I've had conversations where he specifically will say he doesn't bid on state jobs for infrastructure because there's so many different hoops you have to jump through, so many different forms and paperwork. But he also knows that there's a lot of companies who receive state funding to do infrastructure jobs that don't do a very good job with it. So if they have to have somebody come in on the back end and make repairs, You don't have to fill all the paperwork out. You don't have to go through all of these different processes that the state requires you. So what he does is he identifies where these different companies are working. He waits until they're done their job, knows that there have to be repairs that are made to the job that was just completed. He files, he gets money, he charges more money now because it's important that this thing gets corrected quickly. So that's kind of an example of how we inefficiently are not real good at infrastructure jobs. We've had, again, I think we have a history of poorly doing it. So to answer your question, if we were to do it correctly, meaning efficiently, it's the money's going for what it's supposed to, I think it would have a tremendous benefit to the economy. The problem is we haven't done a very good job of it yet. So I'm not convinced that if we do, it's going to have the benefits that we're hoping.
Right.
And that's hopefully one where I'm totally wrong on, and it goes to how it's supposed to.
Yeah. Okay. I can see that point. I can see that.
Yeah.
Kind of going back to like the inflation talk. So recently, like inflation is now synonymous with Bitcoin, right? And Bitcoin has had a massive rally since March from its lows of 4,000, and I think yesterday it just topped 60,000 for the second time, right? Mm-hmm. What are your thoughts? Does Bitcoin have value? I've heard also that Bitcoin might also be in a financial bubble. Is this financial bubble going to pop?
I think it is probably inflated, like a lot of other things. When you have the rapid appreciation that you've had, that again tends to be a sign that there is some overvaluing to it. I think the big area of uncertainty with Bitcoin, because I'll be honest, it has lasted much longer than I expected it, right? Like when it started, and I know I have had some conversations with some of you about it, I did not expect that it was going to, so there was lack of insight on my part. I didn't expect that it was going to be around and sustainable as it has been. Mm-hmm. That being said, the longer it is around and the more viable it is proving to be, I would anticipate that you're going to see more and more government intervention in that market. And which the question then becomes, when the government starts to become much more involved in that market, how is it going to change the appeal of cryptocurrency? Because you tell me, what is one of the big allures of cryptocurrency and Bitcoin?
Could you repeat that question?
What is one of the big draws, one of the big things that draws people in with cryptocurrency and Bitcoin?
Decentralization.
Decentralization. So what happens now if you centralize that? What happens if the Federal Reserve comes in and starts to regulate, or the Department of Treasury comes in and starts to lay all of these layers of regulations on it? What happens to the appeal? So one of the things that I don't know if concerned is the right word for it, but one of the areas that I think that's worth really paying close attention to is if the tentacles, either from central banks or the government itself, really starts to creep into that market in a big way, what's going to happen to that market? Is that appeal, because of the decentralization, is it going to cause the market to collapse? And then because it is such a new industry, if it collapses, is it going to lose most of its appeal and not have the impact that it has now? Or is it going to be able to sustain itself and continue to thrive?
And another question as well, Fed Powell, he said that Bitcoin is going to be more viewed as a digital asset rather than like replacing the physical like dollar and everything. But lately we've been seeing like CEOs like Elon Musk say, hey, you can purchase a Tesla if you have 1.5 Bitcoin. So,
right.
So what about Fed? Is the Fed just like kind of uncertain about it too? Or could you see it people saying like, hey, I want to transfer my Bitcoin to, let's say, buy this house in the future?
I think the Fed, I think maybe their response is similar to mine. And I can tell you, because within like the econ department and other economists I've talked to, a lot of us have kind of had that feeling of it was I don't want to say a gimmick for a while, but it was kind of there, and we really necessarily didn't take it serious, a lot of us, where it has gained. So when you start having Musk, who starts to say, okay, well, you can buy a Tesla with this. When you start to have that, I think what that's going to do is, and oftentimes businesses will change the perspective of the way governments operate sometimes. And I think what you're going to see is the more businesses engage in that activity, the more you're going to have the potential for governments to really start to get involved with it. I think that's when the central bank, I mean, even to the extent of the Fed chair talking about and discussing Bitcoin and cryptocurrency, tells me now that it's on their radar. And once it gets on their radar, if it starts to play a bigger role, and if you can start to make major purchases across the board with it, I would be very surprised if you don't see the government or the Federal Reserve start to really get involved with that market.
So does it start with central banks and then them creating their own and then starting to regulate the Bitcoin and other alt crypto markets? Like, is that something they would do? Is like they would create their own first and then like crack down on Bitcoin and everything? Because like ECB is coming out with their own digital dollar or crypto asset or something soon. They said within the next 4 years. Fed Powell wants to look into it more.
If I think that is a way for them to, again, like you mentioned, they're going to introduce theirs, and then that gives them the ability to start to regulate the other parts of it. And because what's happening is they control the supply of money.
Yep. Well,
so we're changing the supply of money in essence, because what used to be considered the supply of money, which were initially, it was nothing more than hard currency and metals. Then it took the form again of digital transactions in terms of wire transfers, credit cards, debits. Well, now you've got this side piece, this cryptocurrency piece of it that they don't have control over. And I think, again, I may be wrong on this, but I would not be surprised if when you have the European Central Bank, if they do it, I can't imagine the Fed's going to be far behind on their process with it. And as soon as that happens, then you have an easy means to go in and start to regulate that other market, because they're now involved in that market itself.
Last question. I know this may sound maybe laughable, but I've heard some people talk about fears of hyperinflation happening in the United States. Mm-hmm. Is that just like meme economics, or is there a legitimate possibility that could happen?
So if the dollar were not the leading international reserve currency, the fear would be much more relevant. Now, that being said, I would like to think you're not going to have hyperinflation. History has told us that it is totally possible. With the amount of money that we have put in, and part of this, you can even go back to the recession that we had back in, was it 2007, 2000, right? So you go back that far. So we had a massive amount of money that was pumped into the system at that time. There's questions as to what really happened with all of that. Is that, it's still kind of circling, because the Fed at no point really, they didn't raise interest rates and pull a lot of that money out, right? So a lot of that money was in the system. Now we've gone through with COVID and we've put a lot more money in the system. I would say if the US were not the leading international reserve currency, it would not surprise me with hyperinflation. Because there is some stability to it especially because dollars, it's your main currency used to trade energy. So it adds some stability to it, even if there's more currency in than really should be. But so I'm answering your question all ways, so I'm covering myself on this. But is there a potential? Yes. I think you won't see it because, so let me say this, because the dollar is the reserve currency, and because the control that the Fed does have over the dollar, they can very quickly increase the interest rates and start to pull money out of the system. What we have seen historically is where inflation has hit, that tool, that contractionary monetary policy tool, has worked every time they put it into place. So with that being said, I don't think with the Fed, I don't think you will see hyperinflation. I think you will see some inflation, but I don't think you're going to have the hyperinflation part of it.
Okay.
That was a very long answer to that question.
Now, and I guess kind of shifting gears a little bit, we also have like competition with China. That's always been a thing, and kind of going into currency. China has just been slowly been building up in this 100-year marathon compared to how the U.S. is always every 4 years, policy changes and everything.
Right.
So I think they might work. They eventually are about to be the third largest reserve currency. Any thoughts on that?
I think for China, one of the big things that eventually they're going to have to make a transition on is they're going to be fully considered as one of the true international reserve currencies. One of the things we've seen is you have to have a flexible exchange rate, right? So they're going to have to really release control of that exchange rate. If they get to the point where they're comfortable enough to let the currency actually float based on supply and demand of their currency and the other major reserve currencies, I think they're going to have a much bigger impact. The question is, are they going to want to do that because they really like to have that control on the currency because of the impacts that it has on their exports? And that's been one of the big issues between the US and other nations with regards to China is we've heard it talked about with the currency manipulation. And keep in mind, all nations manipulate their currency to some degree or another. The charge has been that they have really kept it suppressed to encourage that export-driven growth that they've had. So if they can get over the concern of not having that kind of control over the currency and let market forces really kind of take control of it, then I think you're going to definitely see their currency play a much bigger role in terms of reserve currency, international reserve currency.
The last question I may have had was on the electric vehicle space. So Biden just announced his $2.25 trillion infrastructure package, and it's doing like having electric buses, moving more to clean energy. But right now, we also see China has a surplus in like battery power technology. And I understand it's because of the way their living situations are set. They don't have the luxury of having charging ports like how we do in the US. So people just need swappable batteries. But do you think the US is able to catch up in that type of sense with battery power? And
if we can properly invest in that infrastructure, like I said, if we can legitimately put it in, and I would say one of the ways that governments can do that effectively is not by them just simply picking one person, but again, kind of having businesses compete in that industry, kind of how we've seen to a degree with when you're talking the space industry and kind of what NASA has done to a degree. If they can do that with the battery industry, I think it would go a long way in moving the U.S. forward in that industry. And one of the things that we have done okay with is, again, you mentioned like you see charging ports at multiple locations, right? You go to a grocery store, a shopping center, you'll see ports there. So that part is good. It's trying to get the other parts of it kind of to meet up with it. And once you do that, I think there's the potential there. I think the biggest risk is going to be how the government spends the money in that industry. If they have businesses really competing for it, I think it would do much better than if you just simply say, okay, well, I'm going to pick this company or that company to provide that service. I think that's where you would get the biggest bang out of that spending.
My biggest fear is that when you have an administration that comes in and doesn't really view clean energy in the same light, then that progress that you have just gets completely halted. And then another country is already like moving on and accelerating in that area.
Yeah, and that is one of the downsides when you have administrative changes sometimes is you can't seem to get progress because somebody comes in, you have 4 years of policies, then the policies shift, then you have the policy shift again. So there's no real traction. That's where it would really be good if, let's say, in the Department of Energy, that they had a consistent policy that most people could sign off on, that regardless of changes in administrations, you could continue moving these forward. But it is kind of tough with that when you're constantly having policy changes.
Yeah. Is there a risk for China having essentially a monopoly on cell production right now? Because there is a lot of cell production shortages and bottlenecks regarding batteries. Is there a threat, especially given like we're about to take off in this EV revolution? Can they use that as like leverage towards us?
Let me say this: prior to COVID, a lot of us didn't think there was that big of a risk. I mean, with international economics, when I would teach it, it was all about trading, and ultimately just whoever is better, ultimately, that's who's going to produce, which is good. But when you see any type of productive factors concentrated so heavily in one area, if you have any type of issue that comes about, it causes some legitimate issues in terms of goods and services making into the market. And what I mean with COVID is we saw when COVID hit, the shortages that we saw in all different types of things in the system, right? We were not prepared. And even I remember reading from a medication standpoint where this number may be off a little bit, but I believe it was like 80 or 90% of all raw materials that went into most medications like Tylenol or Motrin flowed through the province in China where the virus initiated, where it came from, right? So when this happened, there were periods of time where you couldn't find Tylenol in the store. So when you concentrate all of your productive resources in one location, if you have any type of issue, it can cause a problem. Or again, if China is controlling that component, like they have really large control over your batteries in that industry, right? It can cause a problem if they either choose to hold up production or distribution, or if there's anything negative that happens in that region, any type of natural disaster, anything of that nature can really cause problems throughout the system then. So that's one of the things from an international economic standpoint we've really looked at and said, it's good that we produce and specialize, but if everything is concentrated so heavily in one area, whether it's intentional or in this case unintentional, where you had an outbreak of a pandemic, it can cause major issues in your supply chain.
Yeah. So kind of shifting focus to sort of the macro shifts we see. I know we talked sophomore year about the used car sales and how they're going to start to peak around this time, and they have been. And then now we're starting to see the S curve towards new cars in the EV sector. I think over the next 7 years, it's going to get inefficient for people to buy new cars or battery cells because there's going to be bottlenecks with charging stations. So at some point, we're going to have autonomy and some type of autonomous driver system or subscription model where it's going to be cheaper to, I guess, call it Uber and go where you need to go rather than the cost of ownership. Do you see that changing? Do you see that happening?
I don't know if there's going to be a total shift, obviously, away from ownership, because you're always going to have individuals who like that type of system. But I do think there is a pendulum shift right now. There is uncertainty again because of you're seeing more with Lyft and Uber. You're seeing much more in terms of regulations. You're seeing certain municipalities who are making them try to operate as if they're a full-fledged cab service as opposed to independent contractors. So I think depending on what happens with that, if they allow them to kind of operate autonomously, I think you are going to see a continued shift and push that way. I think you're also going to see more of that in terms of the way businesses operate, in terms of parking availability. I mean, we're constantly talking at the university about parking and how they're changing that. Do they want to consolidate, or people use more of the bus systems to come in? Are people using more services to come in versus driving in? So I think you're definitely at the onset of this shift, and maybe not even the onset. We're kind of in the process of it right now, where you're seeing that market shift. The question is it going to shift? And then oftentimes how things happen, it will move back the other way, or is it going to be much more of a permanent shift? And to give you a terrible answer, I'm not sure which way that's going to go. My guess is it's going to move that direction, and you're not going to see that pendulum shift back, but it's not going to be a total industry change altogether, would be my guess.
Yeah, there's also things like Airbnb, which is bringing down the cost, at least rent. I can see down the road them accumulating large apartment buildings and stuff, and then creating like a subscription model where you can live at different spots based on how much you pay. And yesterday we left off before the video cut off. We were talking about ownership slowly kind of fading away with these new subscription models that businesses are taking. Kind of get your thoughts on like maybe the housing market transitioning into that, and also transportation.
Yeah, so I think you're going to consistently see shifts and changes. I don't think you're ever going to see a total mass migration, let's say, into that system where people aren't owning. There tends to be this desire for individuals to own when you're talking about housing or transportation. But I do think you're going to see a shift more away from ownership. So where it's not going to be a total change in the industry per se, I would say that you're going to see more of a shift in that direction. The question is, how permanent will it be? I think you have the potential for it to be more permanent in transportation. In housing, I think it may be a thing similar to outright rental, which we've seen for a very long time, where depending on what's happening with housing prices, interest rates, those type of things, you can see a migration where people are much more moving into renting. And then you see a shift where they're moving from renting back over into buying. So I think a lot of that's going to be based on some current economic trends when you're talking the housing market specifically.
I guess we can lead into the next topic, which is taxes. What are your thoughts on the current tax system? Do you agree with increasing taxes on the wealthy and the implementations the new administration wants to take, whether it be transaction taxes, capital gains taxes, and I think a new one was I think miles driven taxes, where they tax based on how many miles you drive.
So with any of the taxes, if you implement any new tax, and the thing you have to be careful on is that it's being used to replace an existing tax, or change something that's in there, not supplement with it, because we've gotten so much into looking at specific pieces. I know when you guys were in class, we would talk about the income tax, and people will say, well, the income tax is so much lower now than it was 50 years ago. The key difference with that is the effective tax rate, right? So where the income tax may be lower, the effective tax rate is higher when you add all of the other taxes that are in the system, right? So if we implement some type of different taxes, the hope, I think, would be that it's going to replace something and not supplement that additional tax. Because right now, where we're growing the economy, again, we're kind of talking, it's a weird balancing act where we're in right now, because where we're not in a recession at the same time, because of the pandemic, there's still a lot of people who are out of work, but you have a lot of money influx. There's a lot of different moving pieces where you could have another downturn, you could have inflation come in. What you need to be careful on is if you have any type of major raise in taxes. If you remember, that's what we call contractionary fiscal policy, right? And again, contractionary by definition means it shrinks. So anytime you increase that tax rate, it's going to cause a contraction in the economy. So that with the economy being really not on firm footing right now, that's the big thing that we have to be careful of, is that you don't implement this and it causes a contractionary shift in the economy and put you in a recession, even if the pandemic continues to slow down. So it's kind of a balancing act. We have to be careful on with that. I know there's a push right now to increase the corporate tax rate. So again, there's kind of a balancing act with that, because where our rates have dropped recently, there are still other developed economies whose corporate tax rates are still lower than where ours are. And a lot of the issues that we have with our corporate tax rate is there's so many loopholes and exemptions that these big business firms have got placed in the tax code. So my preference really would be, instead of increasing the corporate tax rate, which would really push corporations to move to other nations where they have a lower rate. I mean, historically, we've seen that every single time. And you can look all through history. And anytime you have changes in developed economies' corporate tax structure, businesses will go from the nation that has the higher structure to the lower structure. Mobility of corporations are much easier today than they ever have been. So my suggestion would be, if we're concerned because some large corporations are not paying taxes or paying very little in taxes than they should be. So my suggestion would be, you should really focus on eliminating those loopholes that are giving them special preferential treatment over other business firms. But try to keep that rate in line with a lot of your other developed economies, because you don't want to push these corporations and businesses outside, because then you're going to have a contraction in really the demand for labor in the market. But you had a couple of other taxes you had questions on.
Yeah, but adding to what you just said, I know recently in Maryland, they passed like a digital sales tax. And I got an email from Spotify saying that your payments are going to increase based on that tax amount. So I guess they're going to passing on the cost of that tax to consumers the next couple of years. So yeah, that I do have a couple more questions with taxes. I wanted to ask you, like, what do you think is a better or a more effective tax way? Because I know our economy is sort of shifting into this faster, more digital and more transactional environment. Would it be a better solution to like have micro taxes for all these transactions that are taking place, and then reduce some of these like income taxes and some of these larger taxes that people feel have more effect on their purchasing power, like how much they can spend?
Yeah, if you were to, again, if you were using the micro taxes to replace some of the other taxes, and you kind of mentioned a lot of the micro taxes, they really are consumption-based taxes.
Yeah.
So when you look at it, sometimes there's arguments and debates on who that's really going to impact. But typically, when your income levels are higher, you're consuming more than somebody whose income level is lower. So I would argue that a consumption tax tends to be a much more equitable type of tax, because the more you're generating, the more you're tending to spend. And if you throw these micro taxes on with a lot of these digital transaction things, it's small in nature, it's spread out. So it's not this big hit of a tax when you go to pay for something. I would be much more in favor of something like that, replacing some of the existing taxes that we currently have. I think it would be a much more efficient way of taxing. And I think it would also, it would minimize the contractionary pressure on the economy, but still generate that money that the government would be needing to operate in the process. I don't know. My fear is again, I think, and we've seen this a lot of times, they're going to implement those taxes, but at the same time implementing it, they're not going to really remove anything else off the table. And as you mentioned, one of the big misconceptions is that the business firms are going to absorb the tax, right? We talk about elasticity, but really it's about how the consumer is going to pay. Is the consumer going to pay it more directly, or is the consumer going to pay it indirectly? So if it's a direct tax, that means if you're going to pay it more directly, then the price is going to go up, and you, the consumer, are just going to pay it. You're going to pay the higher price. You're not going to move away from consuming that good. But then there's also that indirect payment that oftentimes we miss when we're talking about the tax impacts. And that is, if the business doesn't pass it on directly to you, they're going to experience a slowdown in sales. And as you know, anytime there is a slowdown in sales for a business firm, the demand for labor is what we call that derived demand for labor. It's derived from, or comes from, that demand for the products that the business firm is providing. So we either see the consumer pay it directly through higher prices, or the consumer pays it through the loss of jobs or the suppression of wages within that industry. So again, one way or another, the consumer is going to pay that tax. The business firm is going to pass it on. It's just how is the business firm going to pass it on? Through job loss or wage suppression, or through that higher price that you're going to pay directly.
Quick question. I was going to kind of like go back on like your corporate tax thing. I know you've I don't know if you've heard about what's been going on in California recently, where there's like a massive migration of people because of tax issues and other issues. And so California is actually, there's been talks of implementing a tax plan, since it's such a massive move that they say hey, you have to still pay taxes in California for 10 years and go slowly decrease. Do you think if there was an adoption of a 30% corporate tax or whatever is going to be added, and there's a massive migration, the United States might try to do something similar to it as well? Say hey, we can't let all of you leave at the same time.
So they could implement something like that. I think there's going to be, there would probably be some legal challenges to that, because if you're being taxed and you're no longer there, it's a hard justification, because many of the taxes where constitutionally we're only supposed to be taxed once, right? So if you technically, I think, and it's been argued a lot of times, that if you have an income tax, you really shouldn't be taxed on anything else, because you're being taxed. So your income is being taxed. So then anything else that you're paying is taxing a second time. But the way that states and the federal government gets around that is they say, well, you're not paying a tax on a certain thing. You're paying it on, I'll give you an example with property taxes, right? People will argue property tax should be paid one time when you purchase, and then it should be done. But they don't argue that you're paying the tax on the purchase. They argue you're paying the tax on the service they are providing to you yearly. If you're no longer residing in that state, for them to tax your income or for a property tax is going to be hard to justify legally because you're not receiving any type of benefit from it. So I do think there would be some legal challenges to that. If let's say it withstood the legal challenge of that, then I think the next big issue they were going to have is it's going to deter people from moving into that state. Okay. So there's two prongs that they're doing. One, they want to try and keep people from moving out. At the same time, you want to try and encourage people to move in. If you're having a migration of people out and they put a policy that says, well, if you come in and then you leave, we're going to penalize you for leaving. Then you have an issue where it's going to be very hard for you to attract people into the state who haven't been there. It's really going to discourage movement into the state. We're seeing it kind of also at the same time with New York. New York's having a problem with people leaving the state. They're talking about different ways to try and discourage people from leaving. And again, that two-pronged problem is if you discourage people from leaving, then you're also going to discourage people from coming in because then you become trapped in that state if you move there.
Mm. That's great.
And I believe did you also have a question on the tax, the driving tax, I believe was the other one?
Yeah, the driving tax.
Okay. Mm. So with that, the economic impact, there's been what I guess is Seattle currently has one, I believe. I believe San Francisco may. I might be wrong on that one. So there's a couple places where there are driving taxes that are designed to almost replace. It's supposed to be used for infrastructure. Mm-hmm. Real quick, just a brief history on that. What kind of caused that is, and we talked about this, there's been this movement to more EVs. As you've had this shift, there's been a drop in the demand for gas. So for a while, they were looking at charging people who purchased your electric cars. There's going to be a charge on that because they weren't consuming the gas, because they were seeing a drop in revenue. You still need to maintain roads, whether it's an electric vehicle or a gas vehicle. But they didn't want to discourage the consumption of your EVs. So then they moved almost to this. The argument is you move to a mileage tax based on miles. One of the big issues they have with that are privacy issues. I was reading actually just recently that I believe it's in Seattle, that they're looking at you can either have like a GPS placed in your car, or you once a quarter go to a location similar to like vehicle emissions in Maryland, where you go once a quarter and they log your mileage. But there's I believe there's an extra fee for that. So if you're paying for that, they're really trying to encourage you to put the GPS system in your car. Then there becomes privacy concerns of individuals. Do you want the government being able to track your vehicle every time you turn it on and drive someplace? So there's kind of outside of the economic realm of it, there's a lot of privacy concerns where certain states you may be able to see it implemented. I think a lot of states there would be pushback where they wouldn't really implement that policy. But then that state I would probably just again keep that gas tax. But if you were to implement that mileage tax, then I really think you should be eliminating that gas tax. Again, because again you're going to be hitting the consumer up twice for that same activity that they're engaged in.
And wouldn't it also like affect like lower income homes, especially because they really rely on like transportation for work, maybe picking up other friends who don't have cars as well?
It would dramatically impact that. And the other part with it too is it discourages individuals' ability, kind of touching on that. Let's say that you are someone who has lower income and you have the potential to get a job that's going to pay you more. It's a little bit further away and you have to get there somehow. It's really going to hurt individuals because my understanding is too, the more you drive from your home location, the potential is they want to potentially have those fees change. So almost discourage you from driving further. But the problem is that really ends up hurting individuals who are working because it discourages you from going those extra miles. So again, if you're talking someone who's in a lower income bracket and has the potential to go get a job that's a little bit further, that's going to pay more money, it's really going to discourage and hurt that individual in the process.
Yeah.
That topic, as like the world kind of moves closer to like sustainability, pure clean energy, things like that, how serious do you think like carbon taxes and like just clean energy taxes can get in the next couple of years?
It's going to be interesting with that, because a lot of that comes from different international agreements. The pushback is, so I'll give you an example. We were talking about China the other day. So where China has had massive investments in clean energy, at the same time, they've had massive investments in fossil fuels and older energies as well. So the pushback from a lot of different nations is saying, okay, well, if we're going to make this push and we're going to sign off on these treaties, then all of the nations should engage in it. So if you were to have all of the nations engage and there's enforcement mechanisms in place, it could be a very effective policy, and it could really kind of give a boost to a shift in the energy industry itself. The problem is if you have some who are engaged in those policies and then others who are signed on but aren't engaged in it. So I think the big thing is really enforcement on that. And if you can really have a level playing field where all of the participants, your major economies, are legitimately putting resources and effort into doing that, I think you could see a real, true, legitimate shift in the energy industry that way.
I kind of want to ask you about Social Security and like your thoughts on the program in general, and like at some point will it fail? Because it seems like it's essentially a giant pyramid scheme where it's dependent on the population and the productivity of that population.
Yeah. So one of the big issues with Social Security, and I believe we had talked about it in class, is that when Social Security was set up, it was designed to be fully funded before it started, right? So if you start having money put in and come out at the same time, there's some issues with it because you can't fully fund it, right? So that's the one part. Then if you have money going in and it's supposed to be kept in what's called the Social Security lockbox, right? It's supposed to go in and only be used for Social Security. At the same time, you have the government go in and take the money out and use it for other items. And then say, well, we'll put it back in at a later date. So it was really started where it wasn't fully funded properly. And then the money has been taken out and used for things where it really wasn't intended to be used for. The other issue with Social Security is when you have peaks in terms of population, and then you have declining population. So when you have a peak in a population and it starts to start drawing Social Security, but the generations behind it have shrunk. Now this group paying in is smaller than the group who's receiving, and it wasn't fully funded to start with properly. So that's where the government has to keep then trying to divert money back in when you keep hearing, well, Social Security is going to be bankrupt in 5 years or 10 years. So almost the way it has been operated, I think a pyramid scheme may be a good description as to how that has been. The problem and how we segue away from that is so many individuals are dependent on it, either currently or even now not really properly investing. So I think you would, have to really do a good job on educating individuals on investing young, even if you're putting small amounts in, right? Almost go into it as if you're going to assume you're not going to have a Social Security benefit, even though you're paying into it right now. And then the second thing is at some point, there's going to have to be a shift politically where they make some type of changes. The problem is anytime you talk about making any changes to Social Security, it is a death sentence for a politician to make any kind of comment on that, right? So if your job as a politician is wanting to get, it's not supposed to be, but realistically, most of the time, it's just wanting to try and make sure you get reelected. You're not going to want us to make many proposed changes to Social Security because you're immediately going to lose the senior vote. You're going to lose a large percentage of the population who is very close to retirement, right? And so really the only group that may be really open to it are individuals who are younger, who are more recently in the workforce. So you're going to lose a big portion of the electorate in that process. But at some point, there's going to have to be some change to it. But anytime there's a proposed change to Social Security, the almost mass hysteria that happens, it's like supercharged politically. What people start talking about, there's stories all over the place in the media from the right or left side on the doom and gloom that's going to happen with Social Security. So it is a really tough situation for politicians to tackle, but at some point it's going to have to be.
Yeah, from outside looking in, to me, it seems like the reason for this wealth inequality is mostly financial illiteracy and these large amount of taxes.
Yeah, it's. I think we do a great disservice by not spending more time, like you said, on financial literacy with individuals. The focus, we should have so much of a focus on that, because again, things that you can do at a younger age can dramatically impact and change your standard of living as you get older, especially with this when you move into retirement age, right? So we've done a terrible job overall with financial literacy, I think, with students at a younger age. And then again, the tax structure is oftentimes structured in a way, because oftentimes when we're doing tax reform or changes in the tax code, oftentimes you have large businesses and large corporate entities who are advising government, making suggestions on how the tax code should be made, which really should have no business advising the government, because they're not going to propose anything that's going to hurt their bottom line. So that's where you get a lot of these exceptions and exemptions and loopholes in the tax code. And if you really restructured the tax code that encourage, I would love to see more benefits. If you were going to give more benefits to businesses, whether it's small, medium, or large, more tax benefits that would encourage them to provide retirements for individuals. Not necessarily where that you mandate it, but there are benefits for the corporation and for the individual. Even if it's a small business, there are easy plans that can be set up where these small businesses, medium businesses can even invest or start and help their employees with investments. But the tax structure is set up in a way that it really isn't beneficial to a lot of these businesses to do that, these smaller businesses.
Wasn't there something that was passed during last administration that was like something similar to that, where I think smaller businesses were able to offer retirement plans or something like that?
They could offer retirements. I don't know how effective the policy was, because I haven't really heard a lot. Now part of that may be because of the hit of the pandemic. And this may be something where you see some changes if we kind of get through the pandemic and within the next year or so. It may be something, but I haven't really heard much on it outside of that there was something. I heard that there was something passed that could encourage it, but I haven't really seen the implementation of much yet. And I'm guessing that's due to the pandemic. It's either the pandemic or the policy was put into place, but it really didn't do a good job of encouraging the smaller. It didn't incentivize the smaller business firms to do that.
I was thinking about like a program that could possibly or potentially replace Social Security. Instead of like these stimulus checks or UBI, I feel like the government at birth, when you're born, could invest $2,000 into something like a Roth IRA where they can't touch it until they're 21 or a certain age. And every month the government would invest $100 on your behalf until you're 21 at a rate of 6% annually with a variance of 1%. That equates to around $48,000 to $62,000 at the age of 21, which is a lot more than any of us had that age. I think that would go a long way as far as like maybe even educational debt, entrepreneurship in general. I feel like it would be much more beneficial system than Social Security.
Well, and the way you described it, it's a much more efficient way of really investing for individuals' retirements. I don't know how familiar you are. I'm not that close in age yet to Social Security, but when you talk to even individuals who are going in to start withdrawing Social Security, there are all these rules, and you fall into all these different letter classes, and they encourage you to actually go to seminars on this. And so when you have a lot of individuals who financially aren't well versed and don't understand a lot of what's going on, and then you couple that with this weird government formula on what you can withdraw and when you can withdraw, and if you're in Group A or Group B, it's really a confusing mess. Whereas with something that you described, it's it's straightforward it is very efficient in what you're talking about and the way that it would be done. And again, you could use the existing system, like you're saying, like you could use a Roth IRA. It's going to be placed in there. And things like your IRAs have fairly clear rules for it. So you don't have all of these other side things you have to figure out. Once you hit this age, you can withdraw. Here's any type, depending on whether it's a Roth or traditional, here's any type of tax implications. And it's pretty straightforward. So I would say that something like that, if you could get the government to do that, would actually be a great idea. The barrier, again, I think is going to be saying, okay, this is going to replace Social Security. And then as soon as you would say that, watch out.
I mean, at some point, we can't rely on the government for our retirement because they are extremely inefficient at doing things.
Right. And the thing that I would like to add to what you were suggesting is if that is your account, so the government set that up, it's efficient, it's streamlined, then if it's an IRA, you would then have the ability to place additional money in. Mm-hmm. So it's really, they're setting almost a nest egg up for you. And then the benefit, if you put additional money in and it's already there for you, it really is a win-win on all sides.
Yeah, because like after 21, your income or whatever job you're doing, you can contribute as much as you want, up to that limit, $6K, if the government has those limits in place.
By the way, on a funny note, don't go a penny over.
Yeah.
Because there's all kinds of, that, right? There's all kinds of tax implications. Right. So I'm getting ready to finish up taxes. And I just got a notice that somehow, even though I entered the exact amount for tax purposes, I got a notice that it was 1 cent, somehow 1 cent more got in. And now there's all these, if I don't correct it by the time I file, there's all these potential penalties and it's,
Yeah, it's bad. It's bad. So I guess the last question, I think this is quasi yours on national debt, if you want to ask.
With the recent capital expenditure that the government has just been putting out and the Fed continuously printing money, is that something that we should be worried about? Because I feel like that was something that was talked about pre-pandemic, pre-COVID. We should be worried about national debt. We should be worried about national debt. But now it's something that's kind of been busting the stream a little bit. That's not something you hear too much anymore.
Yeah, it's to say that it is excessive would be probably an understatement where we're at. There was obviously a necessity to do something when everything was shut down. I mean, again, people were losing jobs, businesses were shutting down. Something had to happen. But when you have debt at the level that we have it, and you probably remember when we had different discussions that the actual debt based on accounting principles it's much larger than is officially reported as is. Because the government, the way they report debt versus the way corporations legally have to report debt, it's different. So the government debt by accepted accounting principles is actually much larger than is actually even officially reported. The question is how do we start to manage that? And at some point we have to start having you may remember this, I said, we have to start having a surplus over deficits in current years. At some point you have to start having that surplus. It's just like an individual. If you have extra money left over, then you can start paying down that debt. The problem that you've got is at the level that we're at, how you even start to service that. I mean, at some point you just have to say, okay, we have to start paying it down little by little. The other big quasi issue that we're going to have is if inflation kicks in and the Federal Reserve increases interest rates, then all of that debt becomes more expensive. The value of it grows because it's all based on, because again, the government is paying interest just like everyone else. So that actual debt, as soon as that interest rate goes up, it's going to grow. So at some point,
And an unintended consequence.
it's an unintended consequence. And part of the pressure where you will hear administrations constantly push for the Federal Reserve to keep interest rates low, one of the reasons is that one, if interest rates go up, it's going to have contractionary effects on the economy. That's one. But then two is you're immediately going to see a growth in the national debt because of the interest that you have to pay on that now. And it's not like we're talking $1 million even, right? I mean, you're talking trillions of dollars. So if you go 1/4 or 0.5% interest on trillions and trillions of dollars, it's a lot of money. There's really two pieces of potential problem. One, the size of it to begin with, and then two, if that interest rate goes up, what's going to happen? So at some point, somebody, whether it's on the legislative side or whether it's the president, at some point, somebody, more than one person, everybody on both sides of the political aisle are going to have to say, okay, we're going to have to figure out a way legitimately to first slow down the rate of growth, right? So it's kind of like you're pumping the brakes. You're going to have to slow down the rate of growth of the debt. Then you're going to have to kind of stop the growth. And then you're going to have to start rolling it back piece by piece. And we've seen this. If you look at post-World War II, right? We had an explosion of the debt, and then they kind of chopped away at it and got it lower. But now really since late 70s, early 80s, we've just seen this gradual growing. And instead of it slowing down or plateauing, it's almost every year it seems to pick up more and more. I would say on a note with that, there are some economic theories out there that technically, if you are an international reserve currency, that you could just potentially keep going and debt has no, you're laughing, have you heard of this?
Yeah.
Yeah, it has no impact at all. Like you can just keep printing money and it doesn't matter. The problem, and you've all heard me say this multiple times, the professor who really got me into economics, he would always say, economic theories are great on paper, but we fail oftentimes in our profession to look at them historically once they've been put into place. And we have never seen a time in human history when you mass print money that it doesn't create inflation. So there may be something valid in this theory, but my nervousness with that theory is that historically we've never seen it prove out. So I would be nervous trying it, because if you get inflation, or as we mentioned the other day, hyperinflation, that's a problem.
That's all I had for you, Leppo. But do you guys have any other questions for him?
I don't have anything. You, Quasi?
Also good. I mean, this is just
All right. Well, it was a really interesting conversation. I learned a lot. Thank you for having us.
Thank you. I have to say, it has been a pleasure talking with you guys again. I have really missed our conversations. So it has been a real pleasure. I really enjoyed getting to come on and talk with you guys for the past 2 days. It has been a real pleasure. Thank you.
I'll keep in touch as usual.
Awesome. No, that's great. That's great. All of you, please, anytime. I'm always glad to hear from you.
All right.
Thanks again.
All right. Have a nice day.